what's the risk of living off an overdrawn director's loan account? Well, it's potentially, doesn't have to be, but it's potentially one of the worst ways of remunerating oneself through a limited company. Now, normally, if you're a director of a limited company and if it's an owner-managed company, you would pay yourself a salary, and if you've got distributable reserves, in other words, profits available for distribution to yourself as a shareholder, then you could declare dividends. What a lot of company directors do is they simply draw money down during the course of the year to live off, to pay bills, and then at the end of the year, when the accountant prepares the accounts, they are faced with this overdrawn director's loan situation. And if there are distributable reserves, you can effectively then declare a dividend, and that will hopefully wipe most of it away. Alternatively, you could vote a bonus, and you could clear it through that mechanism, and then there would be obviously tax consequences there. It's much the same way, I suppose, with a dividend. The problem is if neither of those two options are available, either because you don't have distributable reserves to declare a dividend, or because if you were to declare a bonus, the effect of that would be an instant substantial tax charge imposed on the company, and then you just simply drift along with an overdrawn director's loan account. What will happen is there will be tax levied under Section 455 of the Corporation Tax Act 2010, which will be levied on the company at the rate of 33.75% currently, and then that money will go to HMRC, assuming the company is able to pay it, until such time as the overdrawn director's loan account is paid back to the company, in which case then 9 months after the year end of that being paid back, you can get a refund from HMRC. But the pretty big problem with it is that whilst in theory it might be more tax efficient to run the risk and try to declare the dividend, if the company doesn't have a good year, then the problem just tends to roll on, and if the company has a series of bad years, then the effect of it is that the overdrawn director's loan account goes up on a year-on-year basis, and this obviously creates an ongoing problem that it's very difficult to get out of. And until such time as the company returns to profitability, it's ultimately got a bigger and bigger problem, as each year all of the director's drawings potentially goes into the overdrawn director's loan account instead of the system which would potentially be, under normal circumstances, if you've got a comfortably successful business, more tax efficient through the declaring dividend. But the alternative thing you can do to avoid accumulating this substantial overdrawn director's loan account is simply pay a regular salary. Yes, it's less tax efficient, but the tax is being taken care of each month, and it's spread over the year evenly, conceivably, as opposed to what happens with the overdrawn director's loan account. You end up with a big wallop, and suddenly big chunky tax bills land on your desk. Question, quiz, concern, give us a shout. We know Insolvency inside out.